we are starting to see what life looks like as we re-emerge and reopen as well. I think there will be some opportunities to get some very keenly priced assets.
The whole secular shift of moving towards e-commerce has just accelerated. Logistics is obviously the big winner.
And what we've basically seen is that the institutional investors have kept on wanting to invest in state funds. Yes, the market will be shaken up.
I strongly believe that investor demand into real estate will remain high. So the higher the risk on a specific property, the higher your risk that it will reprice.
Welcome to CapstoneLaw's Private Market Roundtable Real Estate. Welcome to CapstoneLaw's Private Market Roundtable Real Estate. My name is Moritz. I'm a partner with CapstoneLaw Zurich and have the pleasure and the privilege to be the moderator of today's panel. Since the last financial crisis in 2008, many private market assets, including PE and real estate, had an average exceptional years, both in terms of fundraising and in terms of performance. At the same time, prices were getting up to an all-time high. CapstoneLaw helps a number of private equity and real estate providers and investors with their products and investments in Switzerland, Europe, and on a more global basis. And we have seen a number of fairly challenging developments over the last couple of weeks and months in the real estate sector in connection with the global pandemia, which we will discuss over the next 30 minutes. Let me introduce you to our amazing panel. Let me start with Andreea Stefanescu. She's CEO of Solufonds AG, a leading Swiss real estate manco based in Zurich. In Hong Kong, we have John Saunders, who is a member of BlackRock's Global Real Estate Executive Committee and BlackRock's Asia Executive Committee. From Frankfurt, we have Mark Holz, who is Group Head of Research of CORESTATE Captial, a leading European real estate investor. But last but definitely not the least, Roberto Varandas, who will join our discussion from London. Roberto is an executive president of Coast Capital, a Chinese real estate manager, and Roberto is heading Coast Capital's European business activities. Each of our panelists has a distinguished background in real estate, but what makes them different is that they don't all have the same thing. They don't do all the same thing. Their activities basically span from research to investments, from fundraising and structuring to macro services. Together, they will provide us with a comprehensive sense of the current situation and the outlook for real estate in Switzerland, Europe, and more globally. Let us start with Andreea and have a closer look at the Swiss market. We have seen a number of fairly unique developments over the last recent weeks and months. Investment activities were slowing down significantly. A number of funds have postponed or even stopped their fundraising activities, contemplated capital increases. Andreea, you are the CEO of a Swiss real estate manco. What's going on in the Swiss market and what issues are currently popping up in Swiss funds?
Thank you. So good day. It has been some pretty busy weeks that we have behind us. We had in the beginning, the first 2 weeks after beginning of March, we saw a clear down direction of the markets. They've picked up again. So if we have a look at the Swiss real estate funds, which is a little bit special in Switzerland because they're quoted on the Swiss exchange market. And if we have a look at those funds, they had a few rough weeks behind them, beginning as I said, of March. The last months now, if we really look just the last 31 days, we have a recovery. The markets went up again 7.4%. And if we look at let's say the last 6 months, we're basically flat. So we had an absolute slump down of the average 20% for the first few weeks, but quite quick recovery, if I may say. What we've seen, exactly as you said, is there have been some counterparties who decided to either cancel their capital increases or postpone them to the second half of this year. But we had also a few funds during the crisis kept on going with the capital increases. And basically, yes, they had not an oversubscriptions like we saw that in the past couple of years. But we've also seen that most of the institutional investors, because there's quite some diversification in the Swiss market, you have a great part of institutional investors investing in real estate funds, but also some private investors. And what we've basically seen is that the institutional investors have kept on wanting to invest in real estate funds. And so we're pretty confident that, yes, the market will be shaken up, but it remains pretty stable investment opportunity for a big part of the Swiss investors. And we foresee basically that not all the capital increases will be done for the second part of the year, but some of them will still be able to continue their growing path their growing strategy that they decided.
I mean, do you see any difference between, or what's your take between residential and commercial property in Switzerland? And do you see any differences in the different regions, mainly Zurich versus Geneva?
Yes, there are differences. Basically, there were the parts of Switzerland where you had already, and let me maybe get a step back. If you already had a fund which had big troubles to get everything rented out, given that the strategy was specific or they had not so really, let's say, central locations in Switzerland, and those funds will certainly suffer the most in the coming months or years maybe. You already had, let's say, an oversupply in some parts of Switzerland before the whole crisis already. So for certainly, we will have some, let's say, some different scenarios for different counterparties. You will see for sure more problems in the commercial part than in the residential parts, and specific in those commercial parts which were now affected the most by the measures that were taken by the Swiss government. So I'm talking about everything which is restaurants, hotels. Those will for sure suffer. And what we've also seen is that most of the real estate mancos have started doing really quite detailed analysis of their portfolios, of the effects of the measures that were taken by the government on their portfolios. But we've also seen right now that for the time being, the effects are just very limited. Mm-hmm. And what we have to wait now is for the next 6 to maybe 12, even 18 months to follow, and there to see what will happen in the smaller businesses in Switzerland, because a big part of the Swiss economy is really relying on the small businesses. And there we will see also what the effect will be on the real estate in the commercial part.
Yeah, I think what's going on at the moment is you see a lot of rental reduction requests, right, from multiple different people. I mean, how do you deal with these types of things, right? And what is your expected default rate? And ultimately, can you somehow predict the impact on fund performances?
We have a lot of requests. We're trying really to discuss case by case, even if that takes a lot of time. But for the time being, we don't have big default. So if we're having a look now at the rental incomes by the 31st of March, we were at 95% of rental income last week. So I don't know, a week now later how we are exactly. But that already shows that we don't have a big impact, and we have some pretty important commercial funds. So even if in the commercial part, the rental return for the time being is at 90-95%, that shows that for the time being, the measures that were also taken to support the Swiss economy by the government were exactly spot on and very good. But as I said, we cannot predict what's the problem is for the time being. We cannot really predict the length of the measures, how much longer we will have those close downs of hotels, restaurants, etc. And given that the Swiss government is very careful with their decision, as that they don't say immediately right now it's going to be that date is this going to happen, but they're staying very vague with the measures they will take. It's really not predictable, and that's why I'm saying we'll wait to see the next 6 to 18 months to really have a good estimation of the impacts that COVID had on the real estate market. For the time being, a lot is speculation.
Yeah, absolutely. Thank you very much, Andreea, for your insights. Mark, historically, Switzerland has always been kind of a safe haven, not only in terms of the currency, right, but also in terms of real estate investments, in particular in core assets, right? In the context of the developments described by Andreea, what is your view? As a leading European real estate player, how will you compare Switzerland against Europe? Or in other words, what's going on in Europe?
What's going on in Europe? First of all, good morning, everybody. Good morning, Hans. Thank you for the opportunity to participate here. I think the situation in Europe, and to be honest, globally, is very, very similar to what is happening in Switzerland. I can totally confirm the still high interest in the asset class real estate, which to some extent is based on the diving economies, which causes central banks to lower interest rates. So we will be in a even lower rates for even longer environment now, I believe. And this just makes certain types of investors that are dependent on a minimum yield, like many institutional investors, they find real estate still very attractive and very viable. And that is why I strongly believe that investor demand into real estate will remain high, at least going further down the line. I think in the short term, looking at what's going on the investment side, there will mostly be, in terms of real estate transactions, a pause in the market. I think the next 3-4 months, there'll be very, very limited activity. I've seen estimates of the transaction volume in Europe in Q3 and Q2 and Q3 this year only being 10 to 20% of what they've been in 2019. So that's a lot less. But then there's going to be a decent recovery. I think there's still a lot of equity out there, a lot of liquidity, and it's waiting to be invested. And now thinking where it will be invested, I think in the short term, as uncertainty is high, as Andreea said, we don't know where the economy is headed. We don't know how long the situation will last. So uncertainty is very high. So in the short term, investor interest is very focused on the core end of the spectrum. And when I say core, I specifically mean the income side of things. So long leases with secure tenants, that is where the interest is now. And because there's a lot of interest for this specific type of asset, also prices for these type of assets will be very defensive over the next couple of months. And I believe the situation differs the further you go up the risk scale. So the higher the risk on a specific property, the higher your risk that it will reprice. And thinking further down the line, let's say 12, 18 months, when things become a little clearer, I think this repricing also, like every crisis, will bring opportunities to invest in. Because I still strongly believe that as a property investor holding assets for 10, maybe 15 years, you have to think beyond the cycle. You have to think in long-term trends. You have to think about demographics, what's going on technical development, what's going on in, let's say, structural developments like changing consumption habits. And I think repricing at some of the more riskier assets will bring investors certain possibilities to invest in to product at maybe a better pricing than it was, let's say, 6 months ago.
Let's go into a couple of examples, right? I mean, when you look at Europe, I mean, you have the large cities like London, Paris, right? And you have smaller locations. I mean, how do you see the development there?
It very, very much depends on the individual property sector. Of course, you've got the retail side, which is directly hit by shutdowns, at least the non-food part. The food part is doing much better. But the hotel side is similar affected. When looking at the office space, for example, that is where it becomes really interesting, because the office market is something like, let's say, a mixed bag, and your individual performance very strongly depends on the type of tenant that you have. Most immediately affected will be tenants like the co-working industry, which is basically a hotel operator for office users. It's very similar. They're dependent on the income they get, and they have the long-term rent that they have to pay to the landlord, and their revenues are going down already. Looking a bit further ahead, it's probably the finance and the banking industry that will face headwinds from the current situation. In this recessionary environment, you have an increase in non-performing loans, you have this very low interest rate environment, and both of these things will continue to stress, let's say, the banking and finance industry. And as you mentioned, London already, this is probably a place that might be hit by the situation in terms of office investments for office landlords harder than many other cities in Europe, because its exposure to both the co-working space and the banking space is specifically high in London. So at the rental level, you might actually see some strong rental reductions going forward. This is actually something that I've been waiting to see for some years now because of the Brexit situation, but it didn't happen. Now, on top of the Brexit situation, you have the COVID-19 situation and the specific tenants that you have in London. So, well, that said, London might be hit on the short term, but then again, thinking long term, it is one of the global cities, one of the few 2, 3, or 4 global cities that we have. And I strongly believe that a market like London will also recover quickly. So this London might be a place where you can find interesting opportunities, let's say 18, maybe 24 months down the line, if you are in the space of maybe a little higher risk in terms of your investment profile. If you want to be on the more secure side, it's mostly the residential sector that will at least secure your income streams in the short and medium term perspective. Because you've got a very high diversification of tenants. You don't have like 5 tenants or 10 as you have in office buildings, but you've got hundreds. Then the fundamental side for many markets in Europe, for the residential parts, is very good. Vacancy rates are very low. We have not seen this kind of overbuilding in the residential sector that we have seen in the last crisis, that we have seen in Spain, for example. So it's healthier now. And what I've said in the beginning, as investors are looking for security of income, this is what you will find in the residential space, because your tenants will not just disappear. They will stay there and basically pay the rent. What might happen, though, is that we will see lesser rental growth that we have seen in the past, just because there's this recessionary environment.
Mark, you're also quite active in the German market, right? Maybe one final word on Germany.
Well, Germany is in a decent position because its debt situation is much better than in many other countries. So the government is in a very good position to support the economy, and I think it will. What I don't think we will see going forward is this very strong growth that we have seen in following the last recession, because that to some extent was due to the reforms that happened right before the financial crisis under the Schröder government. So I think Germany is still a relatively safe bet. If it's going to be the outperformer like it was in the last recovery, I'm not quite sure about that. But still, a decent place, especially if you want to go lower risk. Germany seems to be in a very decent position in Europe right now.
Okay. Thank you very much, Mark, for your insights to Europe. John, maybe let's switch to Asia and to Hong Kong. I mean, John, you are looking after the Asian markets for BlackRock. Do you see similar trends in Asia as just described by Mark and Andreea?
Similar, yes. I think overall, though, we're further on, obviously, in the profile of managing the virus itself. So we've started to be able to look at what markets look like when they get better and they return to work. China obviously now is largely functioning. I had an amusing call from my head of China the other day, and she said for the first time ever she was delighted to be stuck in a traffic jam on the way to work. So it is getting a little better. I mean, obviously Asia's a diverse group of countries. We tend to focus and operate in the 6 major ones where there tends to be the most liquidity, and examples of this kind of virus, which nobody could have foreseen, are exactly sort of why we do that. I suppose one always ends up potentially being influenced by your own book. I mean, we're in the nice position of having a lot of dry powder at the moment. So perhaps that makes us a little bit more pessimistic because you sort of, you relish the opportunity to put that dry powder to work at good pricing. I think the difficulty that you've got, and I'd say this has the potential to be a worldwide phenomenon. The difficulty that you've got is I've been surprised by, the extent to which governments have intervened in markets, in the UK, in parts of Asia and stuff, saying you can't be evicted by your landlord, which in some countries has sort of led to well, that's great. That means I've just been given a government mandated free 3-month holiday on my rent payments. That then leads to people potentially, breaching loan covenants, which leads people to go to the banks. And again, it's not just in Europe, but in Asia as well. The governments have been saying banks shouldn't, punish people in those situations. So then the banks, have to give forbearance. The concern I've got that there's this sort of pass the parcel of liability transference, but everything at the moment seems to be ending up on the doorstep of the banks. So the bit that worries me a little bit is, I think, is the potential need for delevering, even in markets where the leverage isn't necessarily excessive. Because, I remember, I'm not saying it'll be as bad as this, but I remember during the global financial crisis, one of the problems was that unless you had stapled financing against an asset, it was very, very, very hard and you were going to be able to fund it. And I think, again, buying new and creating new loans is going to be a different market from refinancing assets, for example. So that's the part I worry about. Very big picture, I think if you engage in a quantitative easing experiment, the like of which we've never seen in the history of mankind or economics, fairly obviously in the long term, that's massively inflationary for hard assets. I'm just not sure how steep-sided the valley is before we get to, I don't know whether I'd call it the promised land because it comes with its own problems anyway, but I don't know how steep that valley is before you get there. I mean, a few comments on what's working, what's not. We've been lucky enough to dodge most of the bullets. We weren't big fans of investing in hotels because of the way the operator contracts worked, etc. That's obviously the area that's been hit the hardest. Retail a little hit as well. But actually within the different Asian countries, in terms of requests for rent-free and forbearance, it's very, very different. Hong Kong, for example, we don't own anything in Hong Kong. Again, we did that on the basis of pricing, but it's proved lucky because Hong Kong's been very hard hit. First of all, we had all the protests and then, we moved straight on into the impact of the virus. But then again, we're starting to come out of it. You know, we had a no case day recorded yesterday. But, you know, the markets in Asia are all very different. So in Hong Kong, for example, there's been no guidance saying you shouldn't pay your rents. And I've heard stories of, you know, people trying not to pay their rents or renegotiating contracts and promptly slapped with a writ. And they'll say, we haven't got any assets, so it's not us. But equally in places like Singapore, there's the sort of general forbearance, but people are generally paying their rents. In places like Australia, it's much more patchy. You know, some people you've got to help because you've got restaurants and bars and cafes closed down at the moment. So it's a mixed picture, but we are starting to see what life looks like as we re-emerge and reopen as well.
I mean, thank you very much, John. I think I think it's quite hard, but what is your kind of real estate outlook for Asia or for the main hubs in Asia for the next, let's say, 6 to 12 months?
Look, I think there will be some opportunities to get some very keenly priced assets. I'm not sure that's necessarily unique to Asia. I think people who have very low leverage in well-tenanted properties, you know, particularly in the office sector, in good locations, they're going to be absolutely fine. But, you know, people in markets, and again, I would say this is probably a global comment, people in markets, you know, where they've got construction and development ongoing, where they're going to need to move, say, from a construction loan into a long-term financing. They don't have pre-commitments. You know, some of those are going to be very challenged. I think there's going to be, it's really, as it did with the last big downturn we had, it's going to come down partly to the quality of the asset, but it's also going to come down to the individual circumstances of the owners of those assets as well. And so I think there will be some opportunity to have some good assets pushed out into the market. But the challenge in the early stages will be having confidence that you can actually get debt finance, because I'm far from convinced that that's not going to be a problem. You know, then I'm far from convinced that's not going to be the next shoe to drop, that the banks are basically getting their margins squeezed, and arguably the quality of their loan portfolio is deteriorating through no fault of their own. That probably doesn't make their investment committees and their credit committees enormously enthusiastic about lending. So again, good quality borrower, good name behind you, and it's a good day. That's definitely a good day to have BlackRock on your business card. Doing refinances of good assets, sure, that's fine, but it may be different in different circumstances.
Thank you very much, John, for your insights from Asia. Roberto, I think you guys from Coast Capital, I think you're a kind of a niche player, if you like. You're focusing on China, right? I mean, I think China, that was the kind of the commencement of the crisis. I mean, what exactly happened in China over the last couple of months?
Thank you, Hans. Thank you for the opportunity to wear a shirt and a jacket today from our work from home sort of regime. Maybe I'll just give a little bit of characterize how the last few months happened in Cost Capital since sort of January. And as you correctly mentioned, about 90% of our AUM is in China. The rest is outside. And we focus a lot across the capital structure, so do a lot of debt and equity as well. I was in China mid-January for our annual corporate offsite, and it usually precedes the golden week of the Chinese New Year. And I was already aware of some pneumonia type infection that was going on in Wuhan, because every time I travel over there, I look to see what's happening in case there's any problems. By the time we finished our week-long sort of corporate offsite, and all my colleagues went to New Year Golden Week and to visit their family in their hometowns, from then on, we entered in complete lockdown. So everybody went home in China. We're talking about the last week of January, roughly. And it's just been complete lockdown with everything that we've seen in the press. Fortunately, Cost Capital has approximately 230 employees. None of them were infected, which is quite amazing. We have several offices around China, and it was complete shutdown until sort of the third week of March, where then we started instituting. Teams would come, half of them would come to the office and half would stay working from home. And then sort of from the first week, second week of April, everybody's now working in the office. So pretty much, I'm not going to say business as usual, but a return to some normality in terms of how we work. Now, obviously with rules, there are strict office cleanses. There are protocols to get in and out of the lifts and to go around. Everybody has a mask. Everybody's received protective gear, the minimal. And for those who already have to travel, it's very burdensome. We have to, for example, for those in Beijing, when they come back, they have to be in quarantine for 2 weeks. So you can see it's not exactly business as usual, but there is some attempt to return to normality.
And how has that crisis basically impacted the different sectors, real estate sectors in China?
Well, I mean, we've been exactly looking at this in the last few weeks with the data that's available. China is a very development, as John was mentioning, the development markets are very difficult, and China is one of those markets. There's a lot of development activity in China. And investment for February, that's the figures we have, has gone down 16% just for February. And less in March, but already down. Resi sales are a big component of the activity in China. That's down 40%, just under 40% in February. And it's massive. Less in March, but still quite a big drop. And so from mid-March, you saw there was a growing offshore financing market out of Hong Kong to finance these developers. And that's been growing as the government has tried to lock down a little bit on leverage in the country. So a lot of developers have opted to raise capital from Hong Kong. And that from the mid of March has just dried up, it's stopped, and spreads have moved out from sort of 700-800 basis points out to 1,500 basis points. So that's quite a big move there. The other thing, and due to our capital structure and our shareholder, which is one of the 4 AMCs, one of the 4 bad banks, we do see a lot of the NPL market. Our opinion is that it's going to continue to grow. Prior to the crisis, the Chinese government was trying to delever somewhat the economy and was sort of pushing the banks to clean up their balance sheets. So I think we will continue to see that trend. The stimulus measures that have been sort of enacted recently to kind of prop up the economy. So in terms of the other sectors, I very much echo what John and Mark mentioned about some of the office sector, office buildings showing some resilience. And then obviously the retail sectors has just been, I'm not going to say fall off a cliff, but the whole secular shift of moving towards e-commerce has just accelerated. Shopping center landlords are giving rent-free holiday periods. However, having said that, we are looking at some retail assets, and we're looking at a portfolio currently where footfall numbers, the latest weeks have seen a recovery of up to 60% footfall of what was experienced in 2019 for the same period. So there are some green shoots, but it's just very difficult. And then maybe just to finish, logistics is obviously the big winner with the e-commerce move.
Roberto, what's your outlook for the next 6 to 12 months?
I think there is the investment/economic aspect of this, and then there's the health/economic aspect of this. So the health/economy aspect of what we're going to face is going to dominate. China was very successful, especially at a later stage in the lockdown. The country's characteristics and the government allows for that. So in the big cities, they've managed to stem the flow of the propagation rate. But we're not sure what happens with second waves of propagation. We're not sure whether there will be such a thing as herd immunity as is being touted here, initially in the UK but more recently in Sweden, which they're attempting to create some immunity across the population. So I think that's the big uncertainty. If we do see a big uptick in infection rates again, the politicians' natural reaction is just going to lock down again. So there is the big uncertainty. But as I mentioned, there are some green shoots that we are already seeing, even in retail and in business activity, that are telling us that we have the makings of a recovery in place right now in China. And China is certainly ahead of the rest of the world in that respect.
Thank you very much, Roberto. I think to sum it up, I think we all agree that the corona crisis has an unprecedented impact on the financial markets, and it's quite hard to predict the developments over the next 6 to 12 months, right? But I get from all of you, right, there might be interesting buying opportunities over the next 6 to 12 months. Thank you very much to our panelists for this very interesting discussion. It was a great pleasure to host this roundtable. I hope you all enjoyed the web event, and we hope you also join the next private market roundtable, which we're aiming to end of May. If you have any questions on any of the topics which we have discussed today, please get in contact with us, and we will coordinate feedback with the panelists. Thank you very much, and see you next time.